again, another industry leader, and has very much potential to be amongst some of our top clients.
Right. So just as a follow-up, so this is a shorter ramp-up, right? I mean, last year you got Saffron and BAE. So as you mentioned that it takes a longer time frame for that to ramp up, but the semiconductor deal, since it's not in aerospace and defense, it will have a shorter ramp-up, right? I mean, it will start contributing top line quickly, or is this understanding correct?
Yes, yes and no. So in practice, what you said is correct, but also it depends where the product is, right? So if you want to deal on a new product that has not gone to market yet, then there's a little bit different timeline. So in this case, these are products we already have, and they're now going to be manufactured, with us in India. So it is a much faster ramp in that regard. And then you also are correct that yes, that in sectors like industrial, semi-cap equipment, and medical, these sectors do ramp quicker than what you might find in aerospace or defense, just due to the regulatory requirements of those sectors.
Right. Last question. So even though EBITDA have declined, gross margins have remained flat. So I mean, how do you see that evolving? I mean, gross margins, since a large part of this year's order revenue will be from exports. So do we see further improvement from here, or this is the trend which is going to continue for the quarter? So any thoughts on that?
Srinivas, you want to take a shot at that?
Yeah, so the gross margins will improve. So will EBITDA, right, for the rest of the year. What we had in Q1 is a lower absorption because of the volume. And as volume picks up, we will see better absorption coming in and seeing an improvement. The other thing that will impact is also the mix of the business, right? As you know, 1/3 of our business is at a lower margin, and that starts to change with the growth that we see in the rest of the year. So that will be another contributor to the margin.
Right. Last question. So if Q4, the NWC guidance was 100 days by the management. So obviously this is a temporary quarter with 171 days, but do you maintain that guidance, or do you see it slightly difficult to achieve that?
No, we maintain that guidance. Q1 is definitely one of the issue because of lower volume as well and higher build-up of inventory. We are very actively working to correct both those metrics, and we'll see a substantial improvement in Q2.
Sure. Thanks. All the best. Thank you.
Thank you. We have our next question from the line of Nitin Sharma from MC Pro Research. Please go ahead.
Yeah, thank you. So firstly, how should we see the industrial segment? This is a straight third quarter of YOY degrowth. So how should we see it over a 2 years or 3 years timeline?
So the industrial segment is a broad segment, right? It covers everything from energy to semiconductor to even some infrastructure services. So we have had one of our key clients in the sector work through some inventory that has built up based on some product that we built for them, and they've had some softening. It's been taking them some time to work through that. We have indication that is expected from this one key client to demand to return as they concern through that in H2 of this year. But then there's also the other clients in this sector, some of which are building, and also some new logos as well. So I think most of what you saw as it relates to industrial and our current makeup today, a lot of that is currently being driven by one client slowly burning through the inventory that we built for them.
So is it possible for you to mention which industrial sub-segment where you are facing the issue with this particular client?
So I would just say H2, we see forecasts, we've been given a forecast that in H2 that should be improving again. And then again, we see other programs as well that come into this sector that will also complement that.
Okay. And secondly, the increase the SG&A investment. So can you just talk about the goal and longevity of this cost and how much is the total quantum for FY25?
That question was not clear. Can you please ask?
Yeah, I'll repeat.
I request you to use your handset mode, please.
Yeah. So this SG&A, higher SG&A cost that you alluded to in the PPT. So I wanted to understand what is the total quantum for this SG&A investment for FY25 and what kind of goal behind this investment?
So the SG&A was higher in percentage terms, right? Because the revenue was lower, right? Not in absolute terms. Whatever we have as an absolute SG&A spend multiplied by 4 will roughly be the number for the year, more or less. I don't think there is any significant investment that is coming up in the rest of the year. So as the volume improves, we will see better absorption coming through the year.
Understood. Thank you.
Thank you. We have our next question from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the opportunity. Sir, I really wanted to understand on this industrial client. I mean, what is the challenge which is going over there? Because, when we see 80% drop in revenue on one side, on the other side, the inventory days going up substantially. So if you can throw some more light, some color as to, what is the challenge over there and how do you see that getting subsided? And second question, commensurate to that was on the margins. I mean, is there any one-off in the other expenses because that has also gone up? So how should we see the margins from here on? Will the first half on a half-yearly basis, will we be able to compensate the margins on a half-yearly basis for the loss that has happened in first quarter?
Yes, I'll take the first part of that question, and then I'll ask Srini to address the margins piece. But as I covered on a prior question, the specifics that I can give because we have to, we're limited on what we can say regarding specific clients, is that it's a matter of burning through using the inventory that this client has. This specific client has built up, right? So in this sector, this was a sector that had a lot of supply chain challenges, especially during COVID and shortages, and then even post-COVID, a lot was done to make sure that supply was secured, and so a lot of that was enacted upon in terms of securing inventory, securing orders, etc. So, basically the current situation is that this client is needing to burn through this inventory before continuing with the placement of additional orders.
Yeah, Mihir, and on the margin, there is no significant one-off this quarter. From a year-on-year perspective, last year we had the RSU coming only from Q2. So from that perspective, this quarter has the RSU costs, which the last year did not have, right? So that is the only thing. But what you see right now in terms of the SG&A spread is more or less at the stable level. There is no substantial change or one-off that we can expect from here till the end of the year. The only thing that will come in is as and when the M&A activity picks up, there will be some one-off costs with respect to the due diligence, bank fees, etc. But that for now, we are keeping that out of the markets.
Okay, sure. And this specific industrial client, I mean, will we see situation once again getting normalized from second quarter onwards, or should we see that from Q2 onwards?
I think right now I would just keep it to H2 is what we are. That's the information that we are being provided.
Sure. And just lastly was on the order book. I mean, we were earlier last year, we were looking at a bump in order book in 1Q. But however, given the inquiries which were there at that point in time, but however, that has not flown through. So, how should we see order book building up from here on? I understand that these are lumpy businesses, but the visibility beyond a certain stage becomes important. So how should we read order book from here on?
Yeah, as answered earlier, I mean, it really does come down to the orders coming in for the business that we currently have forecasted within our plan, and along with the growth that we've highlighted and set expectations with as well. So we expect to see that to start to improve. Again, it is lumpy. I don't have another better term for it, but it should start. We should start to see some progression there as our clients need to place orders for the next phases of their programs, and then of course there's new programs which will have a good impact, and then we'll be able to announce those shortly as well.
Sure, that's it from my side. Thank you.
Yeah.
Thank you. We have a next question from the line of Darshil from Crown Capital. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question. Hope I'm audible.
Yep.
Yeah. Hi, sir. So I just wanted to ask that I think previously we've given the guidance of 30% growth. So we maintain that for FY25, sir?
Now, just to clarify, we did not
that is
guidance for a year.
Yeah, sorry, good.
Yeah. When we said we are confident of a 30% CAGR over a 3-year period. So it will be, we will not comment for 25 specifically, right?
Oh, okay. Fair enough, sir. So just to get a sense, maybe how much would our H1 revenue be in general because of a seasonality or, Q1, how much of revenue have we missed out due to, not being able to supply? Could you just get some color on that?
If you look at the last 3 years, I think we have been, H1 has been at 40% and H2 has been at 60%, right? And so therefore, again, we will have a very strong Q2. We can't give out a specific number, but whatever we were expecting in Q1, that has spilled over into Q2 in terms of the shortfall, and we will make it up by the end of H1.
Okay, fair enough, sir. And so with regards to our margins, we just wanted to ask that because of lower absorption, we will not be able to we saw some dip in margin. But on an overall, on the year-to-year basis for the full year, we'll be able to do 11-12% margins. Is that fair enough, sir, to assume?
Again, I will not give a specific guidance. I think our near-term visibility we said was about double digits, which is about 10%, 10 to 11, I would say. And I think any further levers will come after this through the mix of the revenue as well as increased share of B2S business and of course better absorption because of the growth itself.
Okay, fair enough, sir. And just a last question from my end. So the inorganic opportunities that we are seeing, would that be margin accretive or would they, maybe take some time to reach the margin that we are at? So there might be, another temporary shortfall in margins because of absorbing a new business. Any color on that would be grateful.
No, I mean, we can't, again, speak about that. I think, the assumption is that there is only one target. So, it could also vary depending on which target we are talking about. So right now, I'll say our intent is to, sort of acquire companies which will not be diluted, at least at an EBITDA level for us, right? Because of amortization and other things, it could be, diluted at EBIT level. But EBITDA level, we would aspire to get businesses which are very similar to what we have, so that we don't have further headwinds coming from there.
Oh, fair enough, sir. Fair enough. That helps me, sir. That's it from my side. So all the best.
Thank you.
Thank you. We have our next question from the line of Yash, an individual investor. Please go ahead.
Yeah, hi, sir. Thank you for taking my question. Most of my questions are answered, but I have one big question. Possibility that Trump comes in the new election, and we have seen his policies before where he's decided to end wars, etc. So what is the outlook for the industry as a whole, as well as Cyient DLM, wherein if the war comes to an end, especially between Russia and Ukraine and possibly later into the other wars, then can it affect the business on an industry level as a whole?
Let me.
That's a very difficult.
Yeah, I think.
Go ahead. Go ahead.
I think the business that we're doing is not necessarily tied to any one specific instance, right? I mean, if you look at a lot of the business that we're doing for BEL, for example, the ultimate customer is the Indian Navy. That has absolutely no bearing on what happens in the US. The second thing is, if you look at, Trump, no Trump, I think one of the key realities is most companies have decided, or most countries, have decided to rebalance how their defense spend happens. And you're seeing that in India, where there's a lot more indigenization. We're seeing that in a lot of countries in the Middle East, like Saudi Arabia or the UAE, where there's a lot of focus on indigenization. You have companies in Europe, in Europe, that have to spend more according to their NATO commitments on their defense requirements. And in general, President Trump also, assuming he comes back, has always been a proponent for self-defense, which means that if you look at his last presidency, the defense spend actually went up in the U.S. quite a bit. And therefore, purely from that perspective, I wouldn't imagine that a specific instance at this point in time where the world is and where geopolitics are, a specific or a change in presidency in the U.S. will trigger any specific event that will change the spend pattern. So from what our clients are telling us, and not just in the manufacturing business, but also in the engineering business, what our clients are telling us, there is a fundamental change in terms of how countries are looking at defense procurement, defense spend, indigenization, de-risking, and we don't see things changing in any significant manner.
Yeah, that's good. And just a follow-up question. This is slightly towards your semiconductor business. I mean, targeting was that I think the parent Cyient has tried to give some idea that they want to venture out heavily into the semiconductor space. So can we expect some business from that side? And if we can, what will be the likely margins on that front?
So I think it's a bit early to comment on that, and that's probably more a relevant conversation within of the Cyient call. But our intent is to venture quite heavily. We have a very strong semiconductor business, and we also see some significant growth there. All said and done, all these businesses, the one good thing about all these businesses is they're also quite complementary. And therefore, as that evolves, because a lot of the outcome of the ASIC business will be the input to the DLM business, because that business will produce or will design and source chips. But I think it's perhaps a bit early to comment on the specifics, and we will wait till some of the actions start to materialize there.
All right, that's it from me. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, we'll take him as the last question for today. I would now like to hand the conference over to Mr. Krishna Bodanapu for closing comments. Over to you, sir.
Excellent. Thank you very much. So thanks everybody for participating in this call. As I said at the beginning of the call, it's been a good start, slightly lower than what we'd expected, but I just want to assure everybody that it's just quite a simple sort of right shift of where things have headed. For H1, we're quite confident on meeting what we set out as the budget for H1 internally, which means that we are then in a good footing for the rest of the year. As Srini articulated, our visibility was 30% CAGR for the next 3 years, and we're absolutely on track to achieve that. Of course, some of the orders that many of you pointed out are a little bit delayed, but of course, for the short term, we still have an order book that lets us execute, and for the longer term, the pipeline looks better than it has ever had, which will translate to some very, very strong orders. I think the pipeline is already in excess of $1 billion, and even weighted, it's almost $500 million. So we are quite confident of building up that pipeline. I don't see that to be a challenge to deliver a 30% CAGR over the next 3 years. So with that, I'll once again thank you for your confidence and support in Cyient DLM, and we will speak again this time next quarter. Thank you.
Thank you. Ladies and gentlemen, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.